Good day, ladies and gentlemen. It's Precious again. I would just like to recap firstly on what we did, and then the main purpose of this video is to go through our working example, the standard costing working example called Baby Friend. So the working example has been uploaded on Blackboard. You can find it under class examples. So it's there under class examples. You just download it. What I like about it is that it's a step-by-step approach. So it teaches you how you move firstly from a budget to a flex budget, and then how you move from a flex budget into doing your standard costing variances, and then how you report that, and then eventually you get to a point where you do a recon. So it's very important that before you continue with this video, make sure that you've went through the example by yourself, because if you haven't, you might not follow through in terms of what I'll be going through, because I am doing this video with the assumption that you have went through the standard costing class working example, and that you can follow from that. So from our previous video, we've had two videos. The first video, we were explaining what standard costing is and that we use in our daily lives. It is an expectation, it is a decision-making tool, it is a control tool, it is used by a management accountant, which is why you are studying it, because as a management accountant, you need to be using it to make decisions. You need to be using it to be able to plan for your resources. You need to use it to do your business plan projections, pardon me. So that is why actually you're doing standard costing, because the course you have taken leads you to be in a path of a management accountant. But standard costing is really something that we use on the daily basis. You need to just be aware of when and how you use words such as normal, expectation, and standard, ideal, law, requirement, act, as I've explained in the previous video. So that was the point of the first video. The point of the second video was to introduce you to the class working example, just to show you what you're expected to do. So if you go through it, the first few tasks are very easy. You firstly had to prepare a budget, and then you had to prepare the actual income statement, and then you had to compare and see what the difference is. And then from there, that's where we had a problem. So if I can just take you through what we went through, then you will see that we started here. We said we've got Baby Friend Pty Ltd, which we're going to call BF going forward. They manufacture and sell rubber support chairs called Support a Baby. You know those blue, pink, or white chairs that you use for babies? People, you normally give them at baby showers. But it's an old thing actually. I'm sure you've used one as well when you were young. So these bath tabs are used to bath newborn babies. Now you are the management accountant at BF. So immediately when you put on your management accountant hat, you need to understand that you're in a role where you need to plan your resources, where you need to make decisions, and where you need to plan how your business projections are looking. So just think of, if you go back to the slides, just think of that second slide or third slide where I showed you what your role is. So now here they tell you that part of your responsibilities is to draw the annual budget as well as provide management information in order to assist them in exercising control over their planned performance. So remember, control is a very important part of your job, and so is decision making. Right, so you were then given these. Remember, this working example is on Blackboard, and you need to have done it before you actually watch the entire video. So you've been given what is the budgeted assumptions. They've given you what your production and sales volume are. So there's no opening or closing stock. You produced and then you sold everything that you produced. And then there's the selling price, the material that you use, the labor, the variable costs, and all those things. So remember that when we speak of standard costing, you need to cost the object to its totality. So if I'm doing standard costing, if I'm designing a standard costing system for a pen, I need to be able to take into account everything that it took to make this pen. So I need to take into account the ink, the plastic, the colorants that it took for me to end up with having this pen. So now your standard costing system here, you've got material, and then you've got labor, and then you've got variable overheads. But my point is that you will need to have all the components it took to get to your final product. If to get to your final product you had to use plastic, then you have to calculate your standard cost for plastic. You have to calculate your cost for ink, for example, if you are producing a pen. So that is something that we just need to bear in mind. So now the first thing here was for you to prepare a budgeted income statement for the coming year ending May 2020. You will see that if you have done this exercise, these are the values that you should be getting. So in you preparing your budget using 100,000 units as you've been given, you will get to the 25 million that you get there. So as I showed you previously, how you get to the 25 million is simply by saying, if you can see, I hope you can see, it's just 100,000 units multiplied by the selling price, which is 250. So they've already given you the selling price, they've given you the units. So for you to be able to get to the 25 million, that's what you did. It's a simple calculation. And then if you go to cost of sales for your material, they told you that your material is 2 kilograms per unit, and then you are buying it at 80 rand per kilogram. So what that means is that I'm having 2 kilograms per unit. So, and I'm making 200,000 units. Sorry, 100,000 units. So the answer will be 200,000. So I'm making 100,000 units times 2, which gives me the total number of kilograms that I will need to make my final product. And then I just multiply that by the price, which is given there already, which is the 80. So you get how it goes. That's where you get the material, which is a very easy exercise, but I want you to go through it. If you look at the actual, on the other hand, in your working example, they already told you that your actual information looks like this. Your actual information, they've given you your production and your sales. It's still the same, so there's no opening and closing stock. They've given you that you've actually produced 115,000 units instead of the 100,000 units. So there's a difference there. Your selling price is now 230. In the budget, you had budgeted for 250, and then they tell you that it's 1.95 kgs per unit, which in the budget is actually 2 kilograms. So then with that said, remember, when you are going this, you're going to do it step by step so you can be comfortable with all the numbers that are given here. Just as an example, if we are going to look at, you are going to say, for my sales, I have taken the 115,000 and then I've multiplied that by the 230, which was my selling price, 230, to get the 26.45 million. So that's the kind of things that you need to be able to do easily, right? If you look at labor, for example, I'll do the actual labor for you. They told you that the labor hours are 1.45 per unit. For 1 unit, it takes you 1.45 hours, sorry. And then the cost per hour is 32. So before you do this, you need to say, okay, this multiplied by the 115,000 units, because then I get the total number of hours. And then I just need to divide this by 60 so that I get the per hour. And then I can multiply it again by 32. So there's different ways to do the calculation, but you can definitely get to the same answer as me. So what you are looking at then is just trying to make sure that you understand at this point the basics of getting to the numbers that are given here. You understand how to get to the material, you understand how to get to the labor and the variable overheads and all those costs that are involved there. Sorry, this is per this is the total hours and the rate is per hour, so you actually don't need to divide by 60. My apologies there. So you see how you do the calculation. You need to calculate what it takes for the sales, cost of sales, material, labor, variable overheads. The point of this is that if I'm making a pen, I need to take into account all the costs that are involved into making a pen. Right, now we get a problem. We see that there's a difference between what you sold in terms of your actuals and what you sold in terms of a budget, as well as in terms of your cost of sales. Now, if you look at the difference, you end up with the cost of sales that is over budget with 3.5 million, right? So this is where our problem starts from the last video that we went through. This is where our problem starts. We are saying, can we then fire the production manager because they've just went and overspent with 3.5 million? Is that fair? This is where we are. We are saying The production manager overspent with 3.5 million on the production of this year. So we want to cut him out because now he has overspent with 3.5 million. I mean, that's a lot of money. So the question to you was, is that judgment fair? Is it fair to say that I'm going to fire you because you've overspent with 3.5 million without looking at any other thing? Is that fair? What can we do to better compare the budget to the actual? And then from then, we can start preparing what we call a new budget, which for its formal term is a flexed budget. This new budget here is called a flexed budget. Now, flexed budget are very important for you. You can either be asked for a flexed budget in the test, just as it is prepare a flexed budget. But even if I don't ask you to prepare a flexed budget, you need to flex when we are doing standard costing. So I will explain this very important concept of flex budget today. So this is how it goes. Let's go back. What is the main difference between the budget and the actual, right? So there's two differences if you're just looking at the whole thing. The first difference we've already noted is that I've made 15,000 more units actually than what I budgeted. Right? I've made more units than I budgeted. So is it fair to say I've overspent without looking at the fact that I've actually produced more? The answer to that, I hope, is yes. I hope you understand why, right? It is yes. You cannot ignore the 15,000 extra that I've produced, because that 15,000 extra that I've produced has made my material cost go up because I've used 115 and not 100,000. It has made my labor cost go up because I've used 115 because of 100. So that difference, that 15,000 difference, has had an impact on me getting to overspend with the 3.5 million. So that's the first thing. We definitely have to take into account the fact that I've produced more than I've budgeted to produce. The second thing is that the other reason for all these variances are the price hikes. For example, when we looked at material, we had said that the actual cost of material here, the actual was 82, but the budget is 80. So there's a 2 rand difference here already that is contributing to the overall difference of 3.5 million, sorry. So even when we look at, for example, the labor hours, I'll just give an example there. With regards to the labor hours, you can see that I had budgeted that I'll take how many hours? 1.45. Sorry, I had actual of 1.45 hours. Sorry, but I budgeted to actually only use 1.50 hours. So this is now less. So obviously this difference contributed to that. So there's two things that contributed to the difference. It's the production, the 15,000, which is the main thing. And then secondly, it's these price hikes. So every unit in the cost of sales had a different impact in terms of the price. But the uniform thing here is that the 15,000, the extra that you produce, affected all the costs that are involved. The unit costs, they changed, yes, from 80 rand to 82 rand, but that only affected material. And the labor hours from 1.50 hours to 1.45 affected only labor. But the 5,000 is an overall difference between what we budgeted and the actual. So if we come back here, is this judgment fair? Then the answer is no, because when you call him in to fire him, he can just say, well, I spent more because I produced more. Duh, that goes without saying. So no, it is not. Production was higher. So this is something that we have to take into account, right? So now our biggest thing now here is to say, well, if it's not fair, if I cannot use that as a comparison, what then do I need to do to make sure that I still get to a final answer of either saying, hey man, you fired, or no man, let's sit, let's talk about it. What are the things that we need to fix? So then, which takes us to the second bullet, which is asking us what we can do better to compare. Now that is where flexed budgeting comes in. So if I just explain what a flex budget is, which I hope is easy to explain. So a flex budget is saying, this is my budget, this is my actual, and this is my flex budget. Right? You have got a budget, an actual, and then you've got a flex budget. So here you can say, well, there's 100,000 units. There is 115,000 units. Right? And then you can say the price that I spent, let's say, for example, we are only going to be looking at material, right? Let's start with material. So we'll say material. My budget was that I'm going to make 100,000 units, but in that 100,000 units, 1 unit was going to take 1.95 kg. Sorry. This 1.95 kg was the actual, and then the actual price was the 82. So I'm saying I've actually made 115,000 units, and my price is 82. And you're saying, well, we budgeted to make 100,000 units, and then it was going to be 2 kg per unit multiplied by the 80 rands. So now you can see where the differences are clearly in terms of our material. I don't know how else to put this. Anyway, there's a difference in terms of here, the 5,000, which is the main difference, the 15,000, sorry, which is our main difference. And then there will also be a difference between the 2 and the 1.95, which is a usage variance that we will talk about. And there's also a difference between what you bought those kilograms at. You bought it at 80 and then you bought it at 82. So let me give you a business scenario. In a big company, we have different people doing different things. We could have what we call a production manager. We could have a distribution manager, so who just goes and sells what we have. That's a manager. And then the other one is that we could have someone who buys the goods for us, so it's procurement. So a procurement manager. So the procurement manager is responsible for the 80 rand because that's the manager who went to the store and said, well, I know that we budgeted for 80, but it's fine, give me the goods that cost 82 rand, right? And then the production manager was like, I know I need to use 2 kilograms, but I think I'll use 1.95 because of the quality of the goods that I've got. So now, when we're talking standard costing, we need to be able to split these. Remember, standard costing is there so that we can make decisions. So if I want to make a meaningful decision, I need to give meaningful information. So you splitting and saying the difference can come from the price. And for the price, we need to blame the procurement manager because he went and bought goods at 82 rand instead of 80. So now, instead of you saying to me, well, I think you just overspent, you didn't stick to your budget. I mean, if I look at your labor, your material, sorry, you spent 2.3 million extra than what was budgeted for. Then we can say, I'm giving you meaningful information so you can make a decision with that 2.3 million. I'm saying to you the 2.3 million is because of 2 people. There's a procurement manager who went and bought stuff at 82 rand instead of 80. There's also a production manager who got the stuff that this guy bought and they decided to use 1.95 kilograms instead of 2 kilograms per unit. So these are the people that you need to be dealing with. So that's why then we have 2 variances from what I've just explained. We have now a price variance, which comes from the procurement manager buying at 82 rand instead of 80. And then we also have a problem with the production, which is the usage. We call it the usage variance. So these are the variances that we have. To say, well, if we are being fair, the production manager didn't do all these things alone. He didn't get into this 2.3 million variance alone. There were other people involved. There was the procurement manager. There was the production. There was himself also, but he cannot be blamed for the entire 2.3 million. I mean, two rands of that per unit belongs to the procurement manager, and 0.5 per kg belongs to him. So that's where the differences are. So this is where standard costing comes in to say, okay, let us for us to give meaningful information, let us split the differences that we get between our budget and our actual and say they belong to different people. Different people are accountable for them. So we're going to split them, and we're going to look at a price variance, we're going to look at a usage variance, and then we're going to analyze that. But wait, we still have a problem. We still have a problem because in my budget, I budgeted to produce 100,000 units, but I actually produced 115. So now the production manager can still come back and say, hey guys, I think you're being unfair because the only reason we overspent in our division is because we produced more units. We produced 15,000 more units, therefore, I think you can let this one go. That's where flexing comes in. Flexing comes in and says, all things being equal, what were you supposed to spend? So it's saying, let's forget that we budgeted to make 100,000. Let's say, for argument's sake, we actually produced 115,000. And then let's apply our standards to this 115. So it means let's assume that this 115, you bought the kilograms for each unit at 80 rands. Let's assume that, right? Let's assume that you used 2 kg per unit to make this 115, and you bought each kilogram at 80 rand instead of 82 rand. So what we're saying is that we are leaving the total budgeted figure. We're coming back and we're saying we still want to remain with these two problems so we can solve them. We still want to remain with the price and the usage variance so that we can go to the respective parties that are responsible for them, and then we can get more meaningful information from them with regards to why they've overspent or why they haven't spent their budget if it's a favorable variance. So now for us to cut this whole debate about, no, I produced more or I produced less, this is why I've overspent or I haven't spent all the budget allocated to me, we're saying scrap the 100,000. Leave the 100 units. Let's focus on the 115 units, and then take these 115 units and apply these standards to them so that we can actually have a fair performance evaluation if you are making the decision in terms of performance, or a fair resource allocation evaluation to say, hang on guys, before we jump the gun and we make incorrect decisions, let us actually assume that we actually budgeted for the 115,000 units and use then our budgeted unit cost, which is actually what the standard is, to see if there is still differences. Okay, that's a mouthful. Let's put it in practice. Let us now go back to our example and say, if I'm using the logic that I've just given you, I'll use it for material. How do I flex then? How do I flex? Flex. Remember how we flex, we had said the budget and then the actual. We had said here we've got 115, here we've got 100. And then when we're flexing, we will use 115. So we scrap the 100 because we're saying, no, that doesn't apply anymore. So how our new budget will look, we will use the budgeted assumptions. The budgeted assumption, you need to just remember, it was 2 kgs and also 80 rand per kg. So we want to use these budgeted assumptions based on actual to create a new budget, which is called a flex budget. So how then will my flex budget look? You will just say material, and you will say, okay, for material, in terms of price, I had, you go back, 115,000 units, 115,000 units, but for 1 unit, it was 2 kg, which is the budget, and then for the price per the kilograms, it was 80. Right? So now you're saying, I am not going to look at the actual, which the actual is for example 82 rand. I'm not going to look at this 82 rand. I'm going to look at this 115, which is what we actually produce, but I'm going to apply my budget principles or my standard principles to be able to make a fair comparison. Now if you look at then what will you end up with if you are doing this flex budget, or if you are looking at saying, well, I will take your word. I just want to say, okay, it's fine. Let's look at it. Let's ignore the other things and let's just say you are right. How will the new budget look? Please make sure that you've actually done this before you go into the solution, because it's very important for me that you go into the solution after having done it. Sorry, so don't just jump into the solution, right? So like I said, we will now have 80 times 2, 30 times 1.5. So all these are budget assumptions. These numbers, those are budget assumptions or the standard assumptions. However, if you look on the side, you've also got the 115 instead of the 100. You've got the 115. Therefore, this is the only thing that changes. So when you prepare a flex budget, the only thing that changes is the total production or the total sales if you're flexing sales. But for the sake of this example, we are looking at cost of sales, so the only thing that will change is the total production. Your unit costs will remain the same. You will still do your budget based on your unit costs. The thing that will change for you is your total budget, and that is where the main difference was. So you see there, in terms of your new budget, or what we call the flexed budget, you now have 18.4 million instead, right, of having the budgeted amount that you had when you just had multiplied this by 100,000. So that's the new budget. You've got new figures now because of that. So initially you would have just said 100,000 times 2 times 80, but now you're saying 80 times 2 times 115. So the only thing that has changed is the 100 is now the 115. I really hope that you grasp this concept, because it's very important and it's the only thing I'm covering in this video. You need to know how to flex. The only difference is that when you flex, you are now using your actual production instead of your budgeted production, but your unit costs or your standards, they remain the same. And remember, you're only doing this so that things are more comparable. So things are a bit more comparable if you just change a few things. Now, just to recap before I close down, you will see that here in this budget, the original budget and the actual, our difference, for example, for material was 2.3 million. That's how we had a problem with the guy, and we said, but guy, you've overspent with 3.5 million. Now, if you leave that and you say, what if the production units are kept the same? So we've made it more comparable. We are comparing apples with apples. So the units that are now used here is the 115, and here it's the 115. So we've taken away that difference of 15,000. We've now said, okay, let's say you had produced 115 and you had actual of 115. How would then your differences look? And you will see that your difference is now merely 11.5. So now you can go to the production manager and have a different argument to say, hey, but look at the difference that you're having. It is actually 11.5. So what can we do? It's not as big as sitting with someone and saying, you've overspent with 2.3 million. You're saying, okay, it's 11.5, man. What can we do to fix it? Where are you struggling? What was the problem? And then when you say what was the problem, because now you've taken away the problem that we had at the top there of 15,000, then the problem, or where the 11,500 comes from, is here. So he can say to you, man, this problem is because the procurement manager spent 82 rand instead of 80, and I used 1.95 kilograms instead of 2 kilograms. So now we can discuss to say, this 115, this 11.5, where does it link to? Which part of it is for the price? Which part of it is for the usage? So that we fire the right person. Well, it's not always about that, but for purpose of this example, we just want to make sure that we look at the right person and we say, you have overspent. If it's just price, we say, your portion is this. Can you account for that? Can you be responsible? Can you tell us why you went and spent this amount when you knew that you were only supposed to spend a certain amount, for example? Now, like I've explained before, after you've done that, when you've eliminated and you've flexed, your only problem is now variances, and now you can start doing standard costing. So flexing is very important. It's your first step, is to take away the in comparison, is to bring it back, and you say, okay, I see we've got bananas and apples. Let's throw away the apples. Let's just have bananas. Now, if we are comparing banana to banana, then we can go and say, okay, actually, this is where the problem is. The problem is between the price and the usage. And we can go to the responsible person. Now we can say, procurement manager, why did you overspend? Or production manager, you spent less than your budget. What are you doing? Did we allocate more to you than we should have? Where are the loopholes? What should we be fixing? So that's where it is. Now, after all this, after you've done this, after you've eliminated the 15,000 there, you are now left with this. And it leads us to our next point. Our next point being the exciting stuff, the actual standard costing now. It says, now that the reason for over and under spending as a result of production volume is eliminated, that 15,000, we've done away with the 15,000, it is gone. Now we can break down the differences or the variances. In standard costing, we call the differences the variances, but we know that it's basically the difference between your budget per unit, which is a standard, and your actual per unit. So it's difference between your standard and your actual is what gives you variances. So now we're at a point where we can say, okay, let's look further, let's dig deeper. We've eliminated the inconsistencies that we had. Let's look deeper. Now we can go and you say, okay, what is the price and what is the volume variance for material, labor, and variable overheads? Now we can go and we can go deeper into the reasons of us overspending. And that, ladies and gentlemen, is standard costing. The difference between, or the variance between price and volume in terms of the standard and the actual. Just to give you a quick recap in terms of the amounts that we had, so that you can continue to follow. Keep this in mind for labor or for material. Let me use material since I've used that throughout. For material, you had 2 kgs and then you had 80. That was your budget. Remember, we are ignoring the, you can't really see, but like, okay. The point of this is just to show you the difference. So now we are saying we are going to look at the 80, the 2 kg and the 1.5, which is usage, how much you've used, how much were you supposed to use. That's what the differences are. And then we're going to look at the 80 and the 82. How much did you spend? How much were you supposed to spend? So that's the price and the volume variance. The first one being the volume or usage variance, because it's how much you used per unit compared to how much you were supposed to use per unit. And then the second one there being a price variance, because it's saying how much you spent compared to how much you were supposed to spend. So now we can start dealing with our actual problem at hand. So let's do standard costing, guys. Let us do standard costing. Exciting stuff. Cool. This is the material variances. Remember, I said they split between 2. We'll have price variance or difference, and then we'll have usage. The price variance is relatively easy, and it's usually 1 mark in your paper, so it's simple. You need to get it. If I look back, I will say to you, okay, remember we had the price was 80 and then the actual was 82. So already it's the difference between your standard and your actual. So your standard, we said the standard price was 80 rands and then the actual was 82. So now if you just do that calculation, I mean, your answer is 2 rands. Right? Your bank is definitely not broken by 2 rands if you are making a profit in the millions. So definitely then your procurement manager can say to you, come on man, 2 rands. What is 2 rands? So now that is why we quantify it. To quantify it, we're simply saying, what is the impact of this on the income statement? What does it actually mean for us on the income statement? So then that is where we need to multiply by actual quantity. We multiply by actual quantity, that is actual. If you can't see. So we multiplied by actual quantity to actually say, let us now quantify what is your actual problem. What did you cost the company? Now, when you're doing this, it's a very easy calculation, but what I want you to always remember is that what is inside the bracket has a unit measure. So that's what you need to apply outside. For example, the 80 rand was per kilogram. The 82 rand is per kilogram, which means what you multiply here with should be the actual kilograms that you used, right? So if we want to find out what the actual kilograms are, we'll obviously say the 115,000 there, multiplied by 1.95. If you remember, the 1.95 is actual. So we've used this 1.95 as what you've actually used, because we are saying we just want to quantify what did that mistake of 2 rand cost us. He's saying no, it's only 2 rand. So now we're quantifying and we just want to know what the mistake actually cost us. And if you do that calculation, you will see that your answer is 448. Now, very important, when I'm doing variances, if I leave the amount like this, I haven't given an answer, because remember we said we need to provide valuable information that can be used for decision making. So if I just say, well, the difference, yeah, there's the difference there, so you can deal with the difference, but what does it mean? Is it favorable or unfavorable? In our case, the standard was 80. You went and bought things at 82, so this means it's an unfavorable or adverse variance. So unfavorable and adverse mean the same thing, it just means it was a negative impact. So you were supposed to spend 80 rand, you went and spent 82 rand, and I want to quantify it here by looking at your actual quantity that you purchased, and then I get to this. Remember, this, I'm just quantifying, but this is not the procurement manager's fault. His fault is more of why he spent this. But the impact of him not spending 80 rand is this. He did it on 115,000 units. So now then it comes back to give us that difference. Okay, let's take a deep breath. Now we can do volume or usage. So I think I'll get a clean sheet because I actually write very messy. So now we want to look at the usage. With usage, we are saying, well, if you go back and you check, you were supposed to use 2 kg per kilogram. You actually used 1.95. So that's the difference there. So again, you start by looking at what is the standard, what is the actual, what's inside the bracket, before we go to what's outside the bracket, right? So now the standard, we're saying, man, for 1 unit, you need to use 2 kgs. But you actually only use 1.95 kgs. Now we're saying for all of this, you did it for how many units again? We need to use actual units. Remember, we are always flexing. That's why I said to you, either I ask you to flex in a test or you do it without realizing. When you are using 115,000 here for this calculation, you are actually flexing because you're not using 100,000. You're not saying the mistake could be because of the 100,000 or the difference of 15,000. You're saying, no ways, let's take that factor out. Let's use 115 so that we find out what the actual mistake is. But remember, we always quantify. We always quantify. So, excuse me, to quantify, we would use the standard price. You need to check the units that are in the bracket so that you know which price you need to use. Because here we've got kilograms, you can use the standard price per kilogram, which is then the 80. That will then give you your variance of 460. But in this case, it was favorable because you used less than your standard. So this is a favorable variance. So I'm not going to give you a mark if you just write for me 460. You need to say if it's favorable or unfavorable so that I know that you understand what you are doing, right? So you need to say to me, this is a favorable variance, this is an unfavorable variance. So that's where we'll end. So that is standard costing, guys, and the principles are the same. You apply the same principles when you're doing a labor variance. You apply the same principles when you're doing variable overheads and fixed overheads, but we'll look at all the other variances. So for now, please go and if there's certain things you didn't understand in the working example, I hope I've cleared it up. If you still have questions, please email me so that we can clear all the issues. But what I wanted you to understand is all your variance calculation, which is what we covered in this particular video. It was flexing and then the variance calculation. So you need to go back and make sure that you are comfortable with variance calculations, because I'm not going to go back here. In your next video, I'll be explaining reasons for variances, and then I'm going to be explaining other more difficult concepts. I'll actually be using the slides. So for today, I think this is it. Just make sure that you pretty please go and do the standard costing class working example. It will make sure that your basic principles are solid, and then from there you can take it on, and then you can try and do more difficult and more demanding concepts. With that said, ladies and gentlemen, thank you so much for your time. Again, we are trying our best to still work with you and to still have class in the midst of everything that is happening in the country. Please keep healthy, wash your hands, guys. Yeah, so thank you very much until the next video. So when to expect the next video? It will only be after recess. So after recess, we'll then continue from where we are. So I think that's pretty fair, because then you've got enough time during recess to make sure you are on par, to work through the working example, to go through the slides. So your basics should be fine when we come back from recess. So when we come back from recess, I'm really just going to go into the more difficult concepts, into the exceptions. So for now, I am hoping that you'll take this time, this recess period, to do the Nedbank assignment. Yes, you still have that assignment. And then to also just focus on getting your basics for standard costing right. Just something to note lastly, remember that your textbook, you need to use Colin Dury. They will have formulas for the calculations. It's the same if you apply the formula. My only thing with the formula is that you need to memorize the formula. But if you look at what I covered today, you will realize that you are doing the formula without plugging in the formula. You are just understanding the background of things and using logic to solve standard costing questions instead of relying on a formula. But if you rely on a formula, great. Just remember the formula in the test. You don't want to have an awkward situation there in the test. So just make sure you remember your formulas. But it's the same principles. You'll get to the same answer. You'll get to the same discussion and interpretation. So yeah, you do what works for you. And enjoy your recess. Rest a bit. When we come back, it's probably going to be rough. But anyways, thank you guys. Bye.